The S&P 500 just hit the 100th percentile, and the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface and the data confirms it. Right now, the S&P 500 is at 7,563.6, the 100th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection. Snider says the eurodollar system is tightening and nobody sees it. The data says gold rose 1.6% today, moving against the bearish consensus. In the next few minutes, I will show you who the data says is right and what it means for your money this week. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. The commodity analyst called it commodity supercycle. Oil at $87 confirms it. 160-day streak, score 1 for Snider. Dollar liquidity crisis. Yield curve agrees at 0.46%. 10 days running, Gammon called it, credit will blow out. Yield curve at 0.46% confirms it. The volatility expert just moved from wrong to right. The volatility expert's volatility expansion call is paying off. VIX at 16.3 and trending their direction. McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 159-day streak. Hartman might be right, but the data has not confirmed the thesis yet. 153-day streak. The dollar analyst just moved from right to wrong. The dollar analyst is wrong, for now. Gold at $4,570 is moving against the thesis. Score today, 4 right, 2 early, 1 wrong. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. Today's big question, is the dollar about to surge or is it topping out? Snider says the eurodollar system is tightening and nobody sees it. That is the thesis driving the debate today. It sounds right on the podcast and it is a clean narrative. But here's the problem. Gold rose 1.6% today, moving against the bearish consensus. If the data is right and the speaker is wrong, positioning changes fast. Here is what the data says. The dollar index at 99.1, 73rd percentile. Gold at $4,570, 69th percentile, up 1.6% today. Bitcoin at about $74,000, 26th percentile. Bottom line, the data is pushing back against Snider. Until the signals confirm, the thesis is early. If the dollar index breaks below 99, the milkshake theory loses its legs. Right now, it is at 99.1. If gold and Bitcoin both rally while the dollar holds, the liquidity thesis is wrong. The dollar index at 99.1 will track it daily on the scoreboard. Gold at $4,570 will track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 76 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points. Currently at 74 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, CFNAI flashing red. Snider says the eurodollar system is tightening and nobody sees it. The data agrees with that assessment. Phase 1 holds with 76 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Suffolk, NY, payment burden is past the breaking point. Peconic, NY, median home about $1,238,000 on about $64,000 household income. Price-to-income ratio, 19.3. When the math stops working, sellers find out before buyers do. San Diego, CA, payment burden is past the breaking point. Coronado, CA, median home about $2,588,000 on about $135,000 household income. Price-to-income ratio, 19.2. When the math stops working, sellers find out before buyers do. LA, days on market is spiking in Huma. Days on market in Huma moved plus 100% in 30 days, now 248 days. Buyer leverage score, 5,100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, is the dollar about to surge, or is it topping out? Let me show you what happened the last time we were here. The dollar index at 99.1, the 73rd percentile. Notable, but not extreme. In 2022, dollar index hit 114, crushing emerging market currencies and commodities. In 2020, dollar spiked during the March liquidity crisis, then reversed on Fed intervention. In 2015, dollar strength crushed commodity exporters and triggered EM currency crises. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, Bitcoin at about $74,000 is in the 26th percentile. The last time both the dollar index and Bitcoin were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Snider should be paying close attention because the clock is ticking on this pattern. Here is what the data says to do right now. Stay alert on VIX. It is dropping 4.2% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretch territory. Phase 1 holds. No alarms. But the runway at 76 basis points is shorter than last month. 4 out of 7 speakers are right. The commodity analyst, Snider, Gammon, and the volatility expert. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis. We give you the scoreboard. Subscribe and I will see you tomorrow morning.